Right now, you have an unspoken agreement with the market. You don't realize you've made this agreement, but it's running everything. The agreement says if I do my analysis correctly, if I work hard enough, if I'm disciplined and focused, the market will reward me with winning trades. And every time you lose, you feel betrayed. Like the market broke its promise. Like you did your part, and the market didn't do its part. But here's the truth nobody wants to hear. That agreement doesn't exist. The market never agreed to anything. It doesn't know you exist. It doesn't care how hard you worked on that analysis. The one change that makes consistency click is releasing that agreement, that expectation of reciprocity, and replacing it with something completely different. A relationship with probability instead of a relationship with deserving. I know that probably stings a little bit. The idea that the market doesn't owe you anything, that your hard work doesn't guarantee results, it goes against everything we've been taught about how the world works. But this is where most traders get stuck. They bring this expectation of fairness into a domain that operates on completely different rules. And then they wonder why consistency never comes. You've been chasing consistency in the wrong place. You think if you could just find the right strategy, the right indicators, the right win rate, you'd finally be consistent. But that's not where consistency lives. Here's the core misunderstanding. You believe consistency is an output. You think it means regular profits, consistent wins, a smooth equity curve. But consistency is not an output. It's an input. It's regular behavior. It's doing the same thing the same way every single time, regardless of what happened on the last trade or what you think might happen on this trade. The unique insight I want to give you today is this. You can't control wins. You can only control participation. And when you shift your entire measurement system from outcomes to process execution, from did the trade work to did I follow my rules, you suddenly have something you can actually be consistent at. And here's what this delivers. Emotional relief from the tyranny of needing to be right. A clear, measurable path to consistency that doesn't depend on market cooperation. And the profound freedom of knowing exactly what your job is, not predicting, not being right, just executing. The myth I need to bust right now is this. Consistent traders are not people who win more. They're people who behave the same way in drastically different emotional states. That's the entire secret. A consistent trader can take 5 losses in a row and still execute trade number 6 exactly according to plan. An inconsistent trader has 1 loss and starts improvising. And if you're exhausted from the emotional roller coaster of trading, if you feel like you're doing everything right some days and everything wrong other days, this reframe is going to change. Everything. Let me tell you about someone I worked with. I'm going to call him Alex. Alex came to me frustrated beyond belief. He'd been trading for 3 years. He'd spent thousands of dollars on education, on courses, on software. He had a system that he'd tested. It was a breakout system, nothing fancy. But the numbers were good. 60% win rate, 2-to-1 reward to risk. He'd backtested it over hundreds of trades. The edge was real. But in live trading, Alex couldn't stay consistent. Some weeks, he'd follow the system perfectly, take every signal, honor every stop, and he'd have great weeks. Other weeks, he'd take 2 losses and then just stop. He'd skip signals because they didn't feel right. He'd second-guess entries. He'd move his stops. And those weeks were disasters, not because his system stopped working, but because he stopped working his system. So I asked Alex, how are you measuring success? And he said, well, by my P and L. If I'm making money, I'm doing well. If I'm losing money, something's wrong. And that was the problem right there. He was measuring success by something completely outside his control. Weekly P and L is a function of whether the market happened to cooperate with his edge that week. Some weeks it will, some weeks it won't. If you measure success by that, you're measuring success by randomness. So here's what we did. We changed his measurement system completely. We created what I call a process adherence score. Every single day, Alex would score himself on 5 behaviors. Did I take every signal my system generated? Did I honor my stop loss without moving it? Did I hold to my target without exiting early? Did I avoid any revenge trades or impulse trades? Did I follow my position sizing rules? 5 questions, 5 yes or no answers. At the end of the day, he'd calculate a score. If he took 3 trades and executed all 5 behaviors correctly on each trade, that's 15 out of 15, 100%. First month, Alex's average process score was 65%, and this was eye-opening for him. He realized he wasn't losing because his edge was bad. He was losing because he kept abandoning his edge. Every time he had a couple losses, he'd start freelancing. He'd skip signals. He'd tighten stops because he was scared. He'd take profits early because he didn't want to give them back. None of that was in his system. He was improvising out of fear. And improvisation is just another word for inconsistency. Over the next 3 months, Alex focused on one thing: not making money, raising his process score. He wanted 95%. And slowly, week by week, his score climbed 70%, 80%, 85%. And you know what happened? His P and L followed automatically because he was finally giving his edge a chance to play out. He wasn't interfering with it. He wasn't second-guessing it. He was just executing it the same way, every time. That's consistency. And once he had consistency in his process, the outcomes took care of themselves. The insight here is profound. You can't be consistent at winning. Winning is not up to you. But you can be consistent at executing. And if your edge is real, if the math is in your favor, consistent execution over time produces profitability. Not because you're forcing the market to give you wins, but because you're finally stepping out of the way and letting probability do its work. Now let me give you another way to think about this. Imagine a commercial pilot. He's flying from New York to London. It's a long flight, maybe 7 hours. And somewhere over the Atlantic, the plane hits turbulence. It's shaking. Passengers are nervous. Flight attendants are strapped in. It's uncomfortable. But what does the pilot do? Does he abandon the flight plan and turn around? Does he decide to land in Iceland because things got bumpy? Does he start questioning whether London is the right destination? No. He just keeps flying the plan. He adjusts for the turbulence, sure, but he doesn't abandon the route because turbulence is irrelevant to the destination. Your losing trades are turbulence. They're not evidence that your destination, profitability, is wrong. They're not evidence that your system doesn't work. They're just part of the journey. They're part of flying through probability. Consistent traders are pilots who fly the route regardless of weather. They know that turbulence happens. They know that sometimes it's going to be uncomfortable. But they don't change destinations every time it gets bumpy. Inconsistent traders, they're changing destinations constantly. One patch of rough air and they're convinced they picked the wrong route. So they turn around, they try a different path, and they never arrive anywhere because they keep changing course. So here's the question I want to ask you. Are you navigating or are you reacting? Because if you're reacting, if every loss makes you question your entire approach, you will never be consistent. You can't be consistent if you're abandoning your process every time the market doesn't immediately validate it. Now, if consistency is about process and not outcomes, what exactly is the process we're being consistent with? What are we actually measuring? Because this is where it gets really practical. This is where the rubber meets the road. First truth, consistency is not about market behavior. It's about your behavior. The market will never be consistent. Some days it trends. Some days it chops. Some months your setup appears 20 times. Some months it appears twice. Volatility expands and contracts. News happens. Things change. If you're waiting for the market to be consistent before you can be consistent, you'll wait forever. The market owes you nothing. It's not trying to make your life easy, it's just doing what it does. But here's the shift. Your consistency is independent of market conditions. You can execute the same process in choppy markets and trending markets. You can follow your rules in high volatility and low volatility. Consistency means same process, different conditions. And this is freedom. You're not trying to control the external. You're not trying to make the market behave a certain way. You're only controlling the internal, your decisions, your actions, your adherence to your plan. That's it. That's the only thing you're responsible for. Second truth. You need to redefine what you're measuring. Most traders measure daily P&L, weekly P&L, win rate this month, all outcome metrics, all outside your control. And then they judge themselves based on these metrics. Good day, I'm a good trader. Bad day, I'm a terrible trader. Your self-worth, your confidence, your entire identity as a trader is swinging with every tick. That's exhausting. That's unsustainable. Here are the new metrics. Did I take every signal my system generated? That's execution rate. Did I follow my stop loss without moving it? That's risk adherence. Did I hold to my target without exiting early? That's profit adherence. Did I avoid trades outside my plan? That's discipline score. These are 100% within your control. You can score perfectly on these metrics and still have a losing day. And that's fine. That's actually perfect, because you did your job. The market just didn't cooperate this time. But over time, good process plus a real edge equals profitable outcomes. On any single day, though, your job is process, not outcomes. Now here's a paradox that's going to sound strange at first. To become consistent at winning, you must stop trying to win, because trying to win makes you do things that destroy consistency. When you need this trade to win, when you're attached to the outcome, you start making decisions based on fear and hope, instead of based on your plan. You skip signals that don't feel right. You move stops to avoid losses. You take profits early to secure the win. You overtrade to make back losses. All of these are inconsistent behaviors, and they're all driven by outcome attachment. The paradox is this: the less you care about this trade's outcome, the more consistent you become. And I don't mean not caring as in reckless. I don't mean not caring as in it doesn't matter. I mean not caring as in I've done my part, the market will do whatever it does, and I'm okay either way. The shift is from I need this trade to win to I need to execute this trade correctly. One creates anxiety and inconsistency. The other creates calm and consistency. And calm, consistent execution over time is what produces profits. Let me tell you something about your edge that you might not have considered. Most traders think their edge is their strategy, the patterns they trade, the indicators they use, the rules they follow. But that's only half the edge. The full edge is strategy plus execution consistency. A mediocre strategy executed with 95% consistency beats a great strategy executed with 60% consistency every single time. Here's the math. Your real edge is your theoretical edge multiplied by your execution rate. If your system has a 2R expectancy, meaning over time you make $2 for every dollar you risk, but you only execute it 50% of the time, and the other 50% you're improvising, your real edge is near zero. You're giving back all the gains from your system by not following your system. Most traders don't have a strategy problem. They have an execution problem. They keep searching for a better system when they haven't given their current system a fair test through consistent execution. It's like buying a gym membership, going once, not seeing results, and then blaming the gym. You didn't give it a chance to work because you didn't show up consistently. Here's another truth that goes deep. When you measure outcomes, your identity is hostage to randomness. Good day equals I'm a good trader. Bad day equals I'm a bad trader. Your self-concept swings with every trade. You're on this emotional roller coaster where the market is constantly telling you whether you're worthy or not. And the market is a terrible judge of your worth because it's random in the short term. But when you measure process, your identity becomes stable. I'm someone who follows their plan. Win or lose, that doesn't change. The trade can win or lose. That's the market's choice. But whether you followed your plan, that's your choice. And if you followed your plan, you succeeded. That's the new definition of success. And this creates psychological relief that's hard to overstate. You're no longer dependent on market validation. You validate yourself through execution. This is what unshakable confidence actually looks like. Not I know this trade will win, but I know I'll follow my process regardless of what happens. That's real confidence. That's earned confidence. And it's available to you right now if you're willing to change what you measure. Now, I want to clarify something because I know some people here be consistent and they think that means never adapt, never change, be rigid. That's not what I'm saying. Consistency doesn't mean rigidity. Consistency means within your tested framework, execute the same way every time. But you can still adapt position size to volatility. You can still adjust to different market regimes if your system accounts for that. You can still review and improve your process during non-trading hours. Here's the distinction: consistency during execution, flexibility during review. You don't change your process mid-trade based on emotion. You don't abandon your plan because you're scared or because you're feeling overconfident. But you can change your process deliberately through testing outside of trading hours. You can say, you know what? I've executed this for 3 months and my profit targets are getting hit less than I expected. Let me test a tighter target, but you test it. You verify it. And then you execute the new version consistently. That's adaptation. That's growth. But it's structured. It's intentional. It's not reactive. So let's talk about how you actually build this. How do you shift from outcome focus to process focus in a way that sticks? Because knowing this intellectually is one thing. Actually doing it, actually rewiring how you think about trading, that's something else entirely. First practice, create a daily process scorecard. This is simple but incredibly powerful. You list 4 or 5 behavioral metrics. Did I take every valid signal? Yes or no. Did I honor my stop loss? Yes or no. Did I hold to target without early exit? Yes or no. Did I avoid revenge trades or impulse trades? Yes or no. Did I follow my position sizing rules? Yes or no. End of each day, you score yourself. If you had 5 opportunities to execute correctly and you hit 4 metrics on each one, that's 20 out of 25. That's 80%. You track this daily. Your goal is 90% plus process adherence over a month. And here's the key. You don't look at P&L until you've scored your process first. Process score comes first. It's the leading indicator. It's what you control. P&L is the lagging indicator. It's the result of good process over time. But if you look at P&L first, you're back in outcome focus mode. You're back to judging yourself by randomness. So, process first, always. Second practice, reframe your trade journal. Most traders journal entry price, exit price, profit or loss, maybe what they were thinking. That's fine. But add one section, process grade. A+ means flawless execution. You followed every rule. B means minor deviation, but mostly clean. C means significant deviation. You moved a stop or exited early or something like that. D or F means complete violation of process. You totally freelanced. Over time, you'll notice something fascinating. Your profitable trades don't all have A+ process grades. And your losing trades don't all have F grades. Sometimes you'll execute perfectly and lose. Sometimes you'll execute terribly and win. The insight here is profound. Outcomes and process quality are not perfectly correlated in small samples. The market can reward bad behavior in the short term and punish good behavior in the short term. But in large samples, A-plus process grades lead to profitability if your edge is real. So you stop judging trades by whether they won and start judging them by how well you executed. That's the shift. Third practice. Before entering any trade, write or say aloud a commitment. My job on this trade is to execute my plan, not to make money. Whether this trade wins or loses is irrelevant to whether I did my job. I will measure success by following my rules, not by the outcome. This verbal or written commitment creates separation between execution and outcome. You're pre-framing the trade correctly. You're reminding yourself before the emotions kick in what your actual job is, and this reduces emotional attachment to the result. You're not hoping anymore. You're just executing. Fourth practice. Do a weekly process review, not a P&L review. End of the week, don't start with how much money did I make or lose. Start with what was my process adherence this week. Where did I break rules? What triggered it? Was I tired? Was I frustrated from previous losses? Was I overconfident from previous wins? Where did I execute perfectly? What supported that? Was I well rested? Was I calm? Was I following my pre-trade routine? You're looking for patterns in your behavior, not patterns in the market. And only after you've reviewed your process, then you look at P&L. And you ask one question. Is my edge showing up when I execute consistently? If yes, keep executing. If no, after 50-plus consistently executed trades, maybe review the edge itself. Maybe the system needs adjustment. But most traders never get to 50 consistent trades. They execute 5 trades, have 3 losses, abandon the plan, execute 5 different trades, have 2 losses, abandon that plan. They never give anything a fair test because they're not consistent long enough to know if the edge is real. Fifth practice. This one's about identity. Rewrite your trader identity statement. The old version says, I'm a profitable trader. That's an outcome-dependent identity. It's hostage to the market. The new version says, I'm a process-consistent trader. That's a behavior-dependent identity. It's within your control. Every morning before you start trading, read this aloud. Your measure of success today is not profit. It's whether you honored your process. This rewires your reward system at a neurological level. You start getting satisfaction from execution, not just from wins. And that satisfaction, that sense of, I did my job, that's sustainable. That's something you can feel every single day, regardless of what the market does. Now let me bring all of this together because I want to make sure you leave this video with absolute clarity about what needs to change and why. The one change that makes consistency finally click is this. Stop measuring outcomes and start measuring process. Stop asking, did I win? And start asking, did I execute? That sounds simple. It might even sound obvious. But it's a complete inversion of how you've been approaching this. You've been trying to be consistent at something you can't control, whether trades win, and then wondering why consistency eludes you. But you can't be consistent at randomness. The market is random in the short term. Individual trades are random. You can do everything right and lose. You can do everything wrong and win. That's the nature of probability. But you can be consistent at behavior. You can be consistent at following your rules, at honoring your stops, at taking every signal, at managing your risk. That's controllable. That's measurable. That's achievable. And the moment you shift your entire focus, your entire measurement system, your entire definition of success to process execution, everything changes. You're no longer hostage to the market's cooperation. You're no longer swinging between I'm great and I'm terrible based on daily P and L. You have a clear, stable, controllable metric. Did I follow my rules? And that question has a clear answer, yes or no, not sort of, not mostly, yes or no. And when you can score 90%, 95% on process adherence over weeks and months, the outcomes take care of themselves. Not because you're forcing the market to comply, but because you're finally giving your edge a chance to play out. You're not interfering. You're not abandoning the plan after 2 losses. You're just executing. And execution, repeated over time with a real edge, produces profitability. That's not hope. That's math. Here's what I need you to hear. You're not inconsistent because you're undisciplined. You're inconsistent because you've been measuring the wrong thing. You've been trying to control the uncontrollable and ignoring the one thing you can actually control. Your job is not to make the market give you wins. Your job is to execute your process regardless of what the market does. And the moment you accept that, the moment you release the expectation that good execution guarantees good outcomes right now, you'll find the consistency you've been searching for. You don't need a new strategy. You don't need more education. You don't need to be smarter. You need to redefine what you're trying to be consistent at. Be consistent at execution. Let the market be inconsistent. That's its job. It's allowed to chop. It's allowed to trend and then stop trending. It's allowed to do whatever it wants. Your job is different. Your job is to show up every day and execute your plan the same way regardless of conditions. And once you know your job, once it's clear, you can do it every single day. That's consistency. That's the click. And I want you to understand something else. This isn't just about trading. This principle applies to everything in life where outcomes are uncertain. You can't control whether you get the job, but you can control whether you show up prepared for the interview. You can't control whether the relationship works out, but you can control whether you show up with honesty and kindness. You can't control whether the business succeeds, but you can control whether you do the work every day. Trading is just teaching you this lesson in a very concentrated, very expensive way. It's teaching you to let go of outcome attachment and focus on process integrity. And when you learn that lesson, when you really internalize it, it changes everything, not just your trading. Your entire relationship with uncertainty, your entire relationship with effort and reward. Because you stop expecting the world to be fair, you stop expecting that hard work guarantees results. And instead you start understanding that hard work increases probability, that good process over time tilts the odds in your favor. But it doesn't guarantee anything on any single attempt. And there's peace in that. There's relief in that. Because you're no longer carrying the weight of needing to control outcomes. You're just responsible for showing up and doing your part. That's it. That's all you've ever been responsible for. But somewhere along the way, you started believing you were responsible for results too. And that belief has been crushing you. It's been making you anxious and inconsistent and desperate. But it's not true. You're not responsible for results. You're responsible for process. And when you accept that, when you really accept it, the pressure lifts. You can breathe again. You can trade again without your entire sense of self on the line with every position. So if this reframe landed, if you felt something shift in how you've been thinking about consistency, I want you to do something. Comment below and tell me, what are you going to measure differently starting today? Are you going to create a process scorecard? Are you going to stop checking P and L first thing? What's the one behavior you're going to track instead of outcomes? I want to hear it, because naming it publicly makes it real. It creates accountability. And it helps other people see what's possible when you make this shift. And if you want more of this, the kind of trading psychology that actually addresses the root of the problem instead of just telling you to be disciplined, subscribe. Because there's a lot more where this came from. We're not talking about indicators here. We're not talking about patterns or setups. We're talking about the internal shifts that make everything else work. We're talking about the psychological foundation that consistency is built on. And once you have that foundation, everything else becomes easier. Not easy, but easier. Thanks for watching. And remember, you can't control whether you win. You can only control whether you execute. So execute. Do your job. Follow your process. Measure what matters and let the market do whatever it's going to do. That's enough. That's always been enough. You just didn't know it until now.